Hi, everyone. I'm John Zaller, CIO of MAI Capital, here with the latest edition of the MAI Market Update. This month, I'm excited to be joined by Andrew Zalic, Director and Portfolio Manager on MAI's Dividend Equity Strategy, to discuss how the current economic trends are affecting companies in his research coverage. Andrew, thanks so much for joining me today.
Thanks, John.
Well, Andrew, let's start off with just kind of the topic du jour, which is inflation. How are you seeing companies in your coverage managing through this higher inflationary environment?
Yeah, so it really depends on the industry and how easily substituted the good or the service is. So the companies that are managing well are the companies that have pricing power. And pricing power is really an example of a competitive advantage that's desirable in really any environment. But, one area that comes to mind are railroads. And they have full exposure to higher oil prices because, oil is what makes rail cars go. But there's only a finite number of rail cars. So they've been really able to price without any sign of demand destruction because goods need to get to where they're going. Staples is another area. Those companies aren't really seeing any pushback on the pricing that they're taking, especially the areas where there's a lack of private label penetration, where consumers would otherwise trade down to those cheaper brands. And then, energy is an area where it's probably an exception to the pricing power because, drillers can't set the price of oil. But inflation generally makes commodities go up, at least until the point that growth starts to slow from higher prices. So energy has actually been the best performing sector year to date.
Interesting. Maybe we'll transition to the current fears in the market, which is kind of where we're going to go from here over the next 12 to 18 months as the Fed is tightening policy at the fastest clip in the last 40 years. Are you starting to see any demand destruction or any slowing growth in the companies you're covering?
Yeah, definitely. So what you're seeing is that higher prices in some areas is translating into lower demand elsewhere. So retail is a great example where there's been this growth in inventory levels, but now retailers are starting to have to mark down all that inventory. And I would think that, higher oil prices and just higher inflation overall has really shifted consumer spending priorities. But then there's industries where, inflation isn't directly impacting, but the second order impacts are being felt, and banks come to mind. Higher rates were initially viewed as a good thing for banks because they could charge more for the loans that they're issuing. But now investors are really grappling with whether or not rates will rise so much that will slow down the economy, and that would hurt banking activity. And banks have underperformed this year. Looking forward, we're really paying attention to any commentary on future demand destruction. And this past earnings season, we started hearing that from CEOs. And all else being equal, inflation, it's a good thing. It can be a good thing. It can boost companies' revenue, but one company's revenue is another company's costs, and costs are rising across industries. So taken together, that's putting pressure on real incomes and spending power. Now, that commentary, it wasn't widespread. It doesn't necessarily make, a recession the market's destiny. But, if this all leads to a recession, this is probably one of your first signs where you have management teams basically saying, hey, we don't know how much longer we can keep raising prices. So, earnings are going to start being reported in a few weeks again, and we're going to monitor if any of those comments are becoming more widespread.
Very helpful. We said in the outset, your focus and your strategy is on dividend-paying companies. We've seen a repricing of asset prices across asset classes because of this inflationary shock to the markets. Dividend-paying companies certainly haven't been necessarily immune to that, but can you just talk about how investors should be thinking about the role of dividends in a higher inflationary environment?
Yeah, so we really focus on companies that are not only consistently paying a dividend, but they're consistently growing that dividend. And if you're growing that dividend, it can offset inflation if the dividend is growing in excess of the rate of inflation. So, taking one step further, if you're an investor and you're living off a stream of dividend income, if that stream of income is growing in excess of the rate of inflation, obviously you're going to benefit. And, for example, in the strategy our team manages, our companies on average have been growing their dividends above the rate of inflation through the end of May.
Wow. Well, given all the macro uncertainty that is out there and facing us over the next 12 months, could you pinpoint maybe one industry for us that you find attractive in the current environment?
Yeah, I think the defense industry is actually very attractive. So, there's a pretty good earnings backdrop for the two markets that defense companies operate in, and that's the U.S. and then everywhere else. So, in the U.S., defense spending's really had bipartisan support recently and for the last several years. And I think that's going to continue, especially as the U.S. is looking to really modernize all its defense capabilities. And then the rest of the world, obviously, they're reevaluating their priorities with Russia invading Ukraine. And NATO countries especially are looking at kind of the gap between what they're supposed to be spending as a member of NATO and then what they are spending. And I think they're going to close that gap. For example, Germany, shortly after the invasion, they announced a one-time doubling of their budget overnight. I don't think every country is going to double their budget, but certainly spending is going to grow. And then the industry overall for defense companies, we think it's really attractive. It's very consolidated. There's only a few major players, and there's limited competition. Given how sensitive the products are, large chunks of revenue are from customers that are classified. If you look it up in their 10K, it's just classified customers. So those customers, they don't just want to work with anyone. They need partners who they can trust, and that really is advantages the incumbents. And on the products, they're very long product cycles. The planes or the equipment that countries use to defend their borders, they can last for decades at a time. And again, the incumbents with the track records, they're really at the advantage here, because if you're a country and you're going to spend billions of dollars on a program that's going to last for decades and is going to protect your borders, you're going to want to go with the company that's been around and has the track record. You're probably not going to want to take a chance on some new upstart company or someone just getting into the industry.
Very interesting. It sounds like that's an area that has some secular tailwinds behind it. Well, Andrew, thanks so much for joining me today and sharing your insights. And thank you to our clients for listening in. As evident in the discussion today, MAI is hard at work in identifying both the opportunities and risks affecting our clients' portfolios. We utilize a host of internal and external resources to better inform how we're positioning client portfolios for the months and years ahead. This has certainly been a challenging year for investors, but we continue to believe that well-diversified portfolios can weather years like this. And with a long-term perspective, investors can remain patient and opportunistic even when the outlook is challenged. At MAI, we're grateful for the opportunity to partner with you in this important aspect of your life and to help you navigate the ups and downs of the markets. As always, please feel free to reach out to your wealth advisor at any time with questions more specific to your portfolio. Thanks so much for listening, and we'll see you next time.